It's crucial that you understand the tax write-offs that can be leveraged in order to save as much as possible in taxes when you start a new business. Why is that? It's because instead of giving 25% of your business profits in the form of taxes to the IRS, you'll retain that capital and be able to reinvest it into the business to ensure its growth. In this video, I'm going to walk you through the top 5 tax write-offs that every new business owner should know about. These deductions could make a huge difference in your bottom line, so stick around to learn how you can keep more of your hard-earned money. Okay, let's jump right into it. Number 1, startup and organizational costs. Startup costs are the expenses you incur before your business officially opens its doors. This could include things like market research, advertising, employee training, or even travel to secure suppliers or distributors. Organizational costs, on the other hand, cover setting up your business structure, such as legal fees, state and corporation fees, and the cost for organizational meetings. It's important to keep track of these expenses because they can significantly reduce your taxable income. Now, here's the good part. You can deduct up to $5,000 of startup costs and $5,000 of organizational costs in the year your business begins, as long as these costs do not exceed $50,000. And a remaining cost above the $5,000, you are able to deduct, but it'll be spread out over 180 months, starting from the month your business begins its operations. So for example, if you incur $50,000 in startup costs, you can deduct $5,000 immediately, and the remaining $45,000 is spread out over 180 months. So you can deduct approximately $250 per month, starting from the month your business begins operations. Now, here is something about startup and organizational costs that most new business owners don't quite understand, and I want to be sure you understand it, so listen carefully to this detail. A business is considered to have switched from startup mode to operating an active trade or business when it begins to function and performs the activities for which it was organized. This generally occurs when the business starts earning revenue from its intended operations. So why am I telling you all of this? So before your business is active, you're keeping track of all those expenses and categorizing them as either startup or organizational costs. And the rules we just discussed apply. You can only begin deducting the startup and organizational costs once the business is open and operating. To enhance this point, let me provide you with an example. Say you incurred startup and organizational costs during 2024 and you open for business in 2025. You're not taking any deductions in 2024, you're taking them in 2025, and after your business has started, you no longer have startup and organizational costs. You can start writing things off as normal. By the way, I haven't said this yet, but if it's your first time watching, my name is Navi Maraj, and I'm a CPA and tax strategist who helps entrepreneurs just like you save thousands of dollars in taxes. I do this by creating free content like you're watching right now on social media and through a course available on my website at navimarajcpa.com. I think there's a link in the description below. I'll talk about more about that later. Having said that, let's move on to our next write-off for new business owners, which is number 2, equipment and technology. Things like computers, cameras, phones, tablets, machinery, office furniture, and software, these are all essential for running your business. The tax treatment here can be very beneficial. First, under the de minimis safe harbor election, you can deduct amounts paid for tangible property up to $2,500 per item as business expenses in the year are incurred. And this is beneficial because rather than capitalizing and depreciating them over many years, you get the deduction right away. So make sure your bookkeeper and accountant are aware that the person preparing your return is making the de minimis safe harbor election. I've seen that mess up people a lot of times. I don't want you to fall for the same mistake. Okay, second, we have the Section 179 deduction. This allows you to expense the cost of qualifying property rather than depreciating it over several years, right? So if it's more than $2,500, you might want to consider this. For 2024, the maximum deduction is $1,220,000. If you or your tax professional aren't familiar with how this works, you could end up depreciating equipment that you've purchased over several years instead of getting the deduction all in the year you place the property into service. And let's not forget about bonus depreciation. In 2024, the bonus depreciation rate is 60%, allowing you to deduct a significant portion of the cost of qualifying property in the year it's placed in service. By the way, if you're finding these tips helpful for maximizing your business deductions, don't forget to like, subscribe, and hit the notification bell so you don't miss any of my future videos. And let me know in the comments below which write-off you're planning to take advantage of. The third one, number 3, home office deduction. If you use part of your home exclusively and regularly for business purposes, you can deduct expenses related to the business use of your home. This includes mortgage interest, insurance, utilities, repairs, even depreciation. You have 2 methods that you can choose from, okay? You have the regular method where you calculate the actual expenses of your home office based on the percentage of your home used for business. And then you have the simplified method where you deduct $5 per square foot of your home used for business up to a maximum of 300 square feet. For example, if you use 10% of your home for business and your total home expenses are $25,000, you can deduct $2,500. Compare that with the simplified method, right? I just gave you the actual method. Simplified method is where if your home office is 250 square feet, you'd get a deduction of $1,250. Got it? All right, number 4, vehicle expenses. If you use your vehicle for business purposes, you can also deduct the costs associated with its use, such as the gas, oil, repairs, insurance, and again, depreciation. There are 2 methods you can use here. First, the standard mileage rate allows you to deduct a set rate per mile driven for business purposes. For 2024, that rate is 67 cents per mile. So if you drove 10,000 miles for business and you could deduct $6,700, right? 67 cents times 10,000 miles is a 6,700. Alternatively, you can use the actual expense method where you deduct the actual cost of operating the vehicle based on the percentage of business use. What I'm going to explain might be contrary to popular belief, but let me show you how this actually works. Let's say you purchase a vehicle used 100% for business that had a gross vehicle weight rating of over 6,000 pounds and it costs you $75,000. With the Section 179 deduction, you can deduct $30,500 in 2024. In addition to that, you get a 60% bonus depreciation, which equals $26,700. And then on top of that, you have the maker's depreciation. What happens here is the maker's depreciation would apply after Section 179, after bonus, and give you an additional $3,560. So if you're adding all that up, that's a total first year depreciation of $60,760, which is going to be a huge tax benefit for your business. As I mentioned earlier, I teach entrepreneurs just like you how to save thousands of dollars in taxes. Imagine, if you will, joining Daniela, who saved over $30,000 in her first year, or Jeff, who is now saving over $25,000 annually, or even Valerie, another student of mine, who saved over $10,000 in just the first year of implementing these strategies. And there are plenty of other cases of students who have saved $11,000, $6,000, or even $4,000 in their very first year of business if they're just a startup. The reason these results are possible is due to my unique 3-step process that I use to unlock tax savings for even my very own clients, and I teach it to you in the course. First, you'll build a strong foundation, understanding business taxes and accounting fundamentals, so you know exactly how your business should operate. Then you'll learn powerful tax strategies, and nothing is held back. You'll discover how the S corporation save thousands in taxes, how your minor children can help you save on taxes, how you can even contribute over $60,000 to your retirement account. And finally, you'll implement these strategies with me, step by step, using QuickBooks, ensuring that you save every dollar possible. There's no value in the course unless I'm actually showing you how to implement it, and I do so using QuickBooks. And here's the best part. Most of the students complete the course in just a few weeks, so you could be on your way to these massive tax savings in no time. Whether you're a new entrepreneur or running a business with over $1 million in revenue, the course is designed for you. Plus, I offer a 30-day money-back guarantee, no questions asked, so all the risk is on me. If you're ready to start saving thousands of taxes in your business, visit my website at navimarajcpa.com or click on the link in the description below to learn more and preview the course content. Okay. Let's move on to our final tax deduction, number 5, meals. You can deduct the cost of meals when you're traveling for business, entertaining clients, or attending business meetings. Typically, you can deduct 50% of the cost of the business meal if the expense is directly related to your business, but there are different types of meal expenses to consider. Meals eaten by yourself are generally not deductible unless you're traveling for business. If you are traveling for business, then they are 50% deductible. However, meals taken with all employees, like a company picnic, these are generally 100% deductible as a de minimis fringe benefit. So, all right, guys, that's a wrap. These deductions can significantly reduce your taxable income as a new business owner. I want to help you save money and invest more in growing your business. Always keep detailed records and receipts to substantiate your deductions in case of an audit. If you enjoyed this video, subscribe to my channel and click on the notification bell so you'll be alerted when the next one is released. Or if you can't wait and you want to learn more, click right here to watch another one of my videos, and I'll see you either there or in the course.